We are going to start with a keynote lecture of the SCORE Day, and we are very pleased to welcome Klaus, who is a professor at the University of Mannheim and was also professor at the University of Oxford, if I get it right, which sometimes happens. And he has worked on many topics on the core of macroeconomic analysis and business cycles. He has extensively published in many journals, including many papers in the very top ones. And in particular, a good fraction of his work is very realistic about taking expectations formation seriously and applying methods of learning to asset price dynamics, for example. So we thought the organizing committee of this conference that he would be the perfect speaker for our SCORE Day, which is about macroeconomic risk. And I think your lecture is going, we are going to talk in particular about housing, which is, of course, a very important factor of macroeconomic risk, and SCORE has plenty of housing in its portfolio. Actually, I think not. They sold everything. And so maybe we are going to learn more about why SCORE sold all its housing in its portfolio.
So it's a pleasure being here in Paris again. And this is a joint paper where we talk about the role of subjective expectations on household subjective expectations for house price dynamics and how those house price dynamics matter for the monetary policy design, in particular the optimal inflation target, in a world where the natural rate of interest is lower than it used to be. And the paper is jointly written with Oliver Pfeuti, who is here in the audience. Is going to give his talk tomorrow morning, first talk tomorrow morning, and you should watch out for him. He's also on the market this year. And the second co-author is Timo Reinhold, who has actually just started at the ECB, but I still give Mannheim as an affiliation. I can speak more freely. Yes. Okay. Okay, so the starting point of this paper is the observation that there seems to be the widespread belief that subjective optimism and pessimism is an important driver of house price dynamics. So there are two influential papers that make this point around the 2007 US house price movement bust. There's a well-known paper by Kaplan, Mittmann, and Violante who argue that actually an optimism shock is what seemed to have driven, at least they couldn't have come up easily with any other shock that sort of gave them the enormous increase in house prices that the US economy has witnessed. And an early paper by Piazzesi and Schneider that actually also looked at the cross-section of household expectations and showed that there was a segment of the population around 2007 that had rather optimistic expectations about housing prices. Of course, there's then subsequently, following Piazzesi Schneider, but also others, there has been some more investigation into what the data say about how house price expectations perform and how they behave, and in particular how they deviate from the full information rational expectations benchmark that we all like to entertain for its simplicity. Okay, and early work by Case Schiller and Amona Fuster Safar, Kuchler Safar actually uses survey expectations to document a number of patterns, such as that households tend to extrapolate from past house price expectations into the future. There seems to be some underreaction, and they seem to miss some mean reversion. Some of this actually experimental evidence or survey evidence involves experimental components where people are provided with information treatments, and so one can have sort of quasi-causal statements on what information sort of generates for it does to households' expectations. But the important thing is that we have to date no paper that sort of jointly models in an equilibrium framework the dynamics of household expectations and housing prices in a monetary policy environment, okay, in a setup where we can also discuss monetary policy. And this is really the goal of the present paper, is to provide you with a quantitatively credible equilibrium model of the joint dynamics of housing prices and the deviation of house price expectations from the full information benchmark. Okay, so that's the first thing we sort of achieve or hope to achieve in this paper. And then we want to learn something from this framework, namely what is the relevance of these expectational deviations in the housing market for the design of monetary policy, in particular in a world where the real interest rate or the natural rate of interest rate has fallen so much. Okay, so let me preview briefly the findings. So the first thing we do is we go back to the survey data, in particular the Michigan survey, which provides the longest time series. It has been started around 2006-07 when the housing trouble emerged in the United States. It has been added a question about the 1 year and 5 year households' expectations about the capital gains in housing markets. And we document 3 dimensions within this unified data set along which households' house price expectations clearly deviate from a rational expectations benchmark. So the first thing we show is that households' capital gain beliefs are revised too sluggishly. Okay, so they see information, and in response to this information, they revise not strong enough. Okay, sluggish updating. In fact, by a lot. The actual behavior of house prices suggests that the updating speed should be something like 3 to 4 times as strong as it's actually in this survey. The second thing that we document is that this sluggish updating leads to an initial undershooting of what people happen to believe about capital gains in the housing market, but then later on, with a certain delay, to an overshooting. So initially, when things are going well, people are not sufficiently optimistic because of sluggish updating. But then as time progresses, they happen to be more optimistic. In fact, that is something that has been noted in the survey evidence as well, that people miss the mean reversion in house prices, okay, in house price behavior. And then the third thing is something that we document newly that hasn't been documented before, and that is that if you look at the cyclicality of households' capital gain expectations, that is, when are people optimistic about house price gains? When are they pessimistic about house price gains? They get it wrong. So they are optimistic when valuation ratios are high. So when price-rent ratios are high, people are optimistic. But the actual behavior of house prices suggests this should be a behavior at a time where they should be particularly pessimistic. Okay, so the cyclicality of capital gain expectations in housing markets is just wrong. And actually that's something we have documented to be there also with households' stock price expectations. Okay, so then, it gets a little bit embarrassing. So it gets embarrassingly simple, okay, because if you want to explain now this behavior, these expectational deviations from the full information rational expectations benchmark, as well as the actual persistent swings in housing markets, okay, the only thing you need to assume is weak form of extrapolation of past observed capital gains into the future. We know that this from earlier work, that extrapolation is going to give you, because of feedback of realized housing prices into beliefs, and beliefs becoming more optimistic in, again, future house price increases, it's going to give you momentum and also mean reversion over time. But it is also going to replicate all these 3 dimensions of expectational deviations from the full information benchmarks. So all these 3 facts you can get with that. At the same time, we know from the survey evidence that there is a lot of independent evidence in favor of extrapolation. And you need very little of this extrapolation, okay? In fact, sufficiently weak so that you get initial underreaction as one of the patterns. Okay, and this is going to be achievable. You're going to achieve, with a very simple model, a very good fit in terms of matching the large and persistent swings of housing prices and these expectational deviations. So we're going to provide you a bare bones model achieving that, and then we're going to embed this model into a full-fledged sticky price monetary policy model that also features now a housing sector where housing is produced and housing supply expands, say, in response to very high prices in the housing market. Okay? That model will also feature a lower bound constraint so that we can reasonably talk about the effects of a lower natural rate of interest on what monetary policy should do. Okay, so in this model then, households as well as firms are going to be what we call internally rational. That is, they're going to maximize discounted sums of utilities. They're going to be unconstrained optimizers. The only thing they're going to have is a subjective prior. Okay, they're going to have the wrong prior, and we're going to specify the prior in a way that it's going to give rise to these weak forms of extrapolation. And in fact, that is shown, as I showed in the simple model, or is going to replicate these expectational deviations. Okay, so the beliefs, again, going to replicate these patterns. And what is it new that now we learn from the monetary policy model relative to the simple model? This is not the way we're going to go. So in this model, once you talk about monetary policy model where some goods are sticky, the regular goods, and some other goods are more flexible, like the housing price, okay? You're going to get usually in trouble, okay? One trouble is that in response to monetary policy shock, some of the goods, the flexible price goods, respond differently than the sticky price good, and you got to get in paradoxes, okay? We're going to set up our model that we don't get these paradoxes. In response to monetary tightening, housing investment is going to respond stronger to tightening than the non-housing component, so that we have more responses in the housing sector, and therefore a more plausible specification than would otherwise get in setups that have sticky prices. So we think this is a useful framework for understanding monetary policy. And then because we set up the situation, the model in a way that the monetary policy model, the monetary policy maker, cannot exploit the way households form their beliefs, and particularly cannot manipulate belief formation, okay? We can also reasonably talk about optimal policy design, okay? Because there's going to be no Lucas critique to the way households' deviations behave relative to the full information benchmark. Yeah.
So these are something that monetary policy cannot affect. Do you think that's going to be too much strong assumption? Because one thing that will be able to affect expectation,
Well, monetary policy is going to affect house price dynamics, but it's not going to affect how the beliefs of households are going to respond to its actions. Okay, so obviously consumption decisions going to respond, the expectations going to respond, but there is some part of the beliefs that doesn't respond to that. So you cannot do, say, better than under rational expectations by knowing exactly how the private sector would respond to your actions and then exploit that in ways that you get even better outcomes than under rational expectations. I think that's a desirable feature from a theoretical point of view. Whether that is all plausible is, of course, a different issue. Okay, so then we investigate in this framework what are the implications for optimal monetary policy design when you're in a situation where you're confronted with lower natural rates of interest. We have seen this morning, there's ample evidence that this is something that has happened over the last 30 years or so, even though it may be coming back to a situation with higher natural rates. So in line with the data, we find that, we show actually in the data that when the natural rate of interest is lower, the subjective expectational deviations become more relevant. In particularly, they become the momentum components that are generated by belief updating, by extrapolation, lead to more volatile housing markets. Okay? So the model predicts that as the natural rate falls, the volatility and therefore the risk in housing markets is going up. And that's something that you wouldn't get on the rational expectations. And this has implications because more volatile housing prices going to induce more volatile supply responses in response to these fluctuating housing prices. And that is going to make the natural rate of interest, which stabilizes the output level, more volatile. So at the same time as the natural rate of interest drops, the fluctuations around that lower level of the natural rate also become larger. And that's, of course, something that exacerbates the lower bound problem for monetary policy. Okay? And that is a channel that would be entirely absent, that would you miss if we had not looked at these expectational deviations. Under rational expectations, this is just not going to happen, because the natural rate is completely specified by exogenous driving processes. Okay, and this, of course, is going to lead then for monetary policy, is going to make it more relevant to promise future inflation in order to lower the real interest rate. And under Ramsey optimal monetary policy, therefore, you get a response of the average inflation rate that is coming out of the Ramsey plan, as the natural rate falls. In particular, our quantification suggests that for a 3% fall in the natural rate, which is probably in the ballpark of things we have seen, you're going to get a 1% increase in the average rate of inflation under the Ramsey plan. Okay, so 3% fall, 1% increase. You get close to nothing under rational expectations, because the optimal Ramsey plan under rational expectation is very insensitive to the level of the natural rate, as I will show to you. Okay. So what all this suggests is that if you want to tease out, what are the monetary policy implications of lower natural rates, it is important to have a correct vision of how the subjective, of whether or not, you have subjective elements in households' house price expectations. So this is an example of where the expectations assumption that you usually stuck into your model makes quite a substantial difference for the policy conclusions that you reach. Okay, so let's now go through these various points. So I will first document the deviations from rational house price expectations that we can find in the survey data. And then I'm going to present a simple model that quantitatively replicates these deviations, as well as some features of house price behavior. And then we're going to stick this in the full model. I'm going to be there relatively brief, and then tease out some policy implications. Also going to decide, at the end, if I have time, also going to talk about macroprudential tools as an alternative approach to dealing with the problem. Okay, so as I said, we look at the survey of consumers in the Michigan survey. Has around 15 years of data. We focus on the 1 year ahead house price expectations in that survey. The survey also has 5 year ahead expectations. We show in the paper that the behavior is very similar for the 5 year horizon. And we're going to look at the mean or median expectations, which essentially means cross-sectional heterogeneity is measurement noise. Which I think to first approximation is not a bad approximation to make. There are some systematic differences, but there is a lot of noise in these surveys. Okay, and for actual house prices, we're going to use the Case-Shiller index. Okay, so
house owners, or they're just average?
Some of them are house owners, not all of them. So we also have subsets. Okay, so the first thing is we document the sluggish updating of house price expectations. So here on the left-hand side, you see the forecast error about 4 quarters ahead housing prices. Okay, and we regress this forecast error on past expectational revisions. So how did your expectations in the prior quarter, about 4 quarters ahead housing prices, move up or down? Okay, so this is a measure of the expectational revision. Of course, under full information rational expectations setup, past expectations are part of your information set. They should not be able to predict future errors. Okay, but that's not what we're going to find. We're going to find that this coefficient, the Korobyon-Gorotnichenko coefficient, BCG, is positive. In fact, it means that, if you have revised upward your expectation about 4 quarters ahead housing price from 1 quarter to the next, then you're going to under-predict what actually is going to happen, okay? It's going to predicting forecast errors, positive forecast errors tomorrow. And you should have updated stronger, okay? So a beta of positive, a beta that is positive, a B that is positive, is going to tell you that you're too sluggish in your updating, okay?
This is somewhat different to the Gornychenko because the forecast isn't about the same quarter.
But that doesn't matter. The logic goes through as well. You know, all that is in your past information set, okay, should not be able to predict what future forecasts errors are. Otherwise, you're not rational. Can take the 10-year lag, anything. None of those should predict, right? Okay, and that's it.
But here, the QT plus 3 is a different forecast period, right? So
sure. So what? It's part of the information set, unless you forget things, which is not part of the fire assumption. Okay? So that's, you know, it's the same logic, but it's a different regression specification that comes out because we don't see 5-quarter ahead forecasts in the survey. Okay? We can also instrument the right-hand side. We have done instrumental variable things. Thing comes out the same. It's in the paper in the appendix if you're worried about that, reasonably worried, because you have the same variable on the right and left hand side entering with different signs. You probably expect that the B is negative, okay? But it's actually going to be positive, okay? That already indicates that, okay. So what do we find? Now, we do this both for nominal housing prices or we use real housing prices because in normale we're going to have real housing prices later on. But you're going to find very similar things. You can look at the mean or the median expectations. So this coefficient is between 2 and something close to 3, which means, the updating that you have actually done in your revision from one quarter to the next should actually have been, 3 to 4 times as strong than actually you did it. You should have added 3 times that or added 2 times that in order to avoid making these forecast errors. Okay, and that's of course an unconditional statement. It doesn't mean that you have to do that every time, but on average across the periods, okay, that's what you should have done. You should have updated 3 to 4 times as strongly than you actually did. Okay, that's quite striking evidence.
So these results also hold, say, with expectations of experts?
We don't see in the housing market experts' expectations. At least I wouldn't know of a survey source. We have looked in the stock market for experts. The Case-Shiller index has experts. We saw also so there, when we come to the cyclicality issue, I can talk about that, what we find for there we don't see, so the actual capital gains are counter-cyclical in the stock market, and the households have pro-cyclical expectations. The experts are a little better than that. They have acyclical expectations, but still significantly different from the counter-cyclicality implied by the data. So you see less of a bias. We also have looked at households with more and less years of experience in the stock market, and we find also that the degree of extrapolation is less pronounced for households with more experience. Okay, so you see some systematic differences, but they are overall not too big. Okay. We also have documented that for the CFO survey, which is another survey, the Chief Financial Officer survey. It's very similar to households actually for them. Okay. But here in the housing market, there are not. I mean, if anybody has expert surveys, that would be useful. Maybe you should ask SCORE what they predict about housing markets going forward. Okay, so the second thing is we now come to the cyclicality of capital gain expectations in the housing market. So here we follow our earlier work on stock markets, where we've shown that people are optimistic when the price-dividend ratio is high, while actual capital gains are particularly low subsequently, which is known since the work of Campbell and Schiller, Farmer and French, and so on. So here we observe the very similar thing. So what we do is we regress expected capital gains on a measure of valuation, like the lag price-rent ratio, okay, which is analog to the price-dividend ratio. And we also regress the actual capital gains on the measure of housing market valuation. And then, of course, if this measure of housing market valuation is in your information set, okay, then this projection shouldn't generate different coefficients, okay? If it's part of your information set, then you should be able to predict the forecast error, the difference between the two, by this variable. But what we find is that actually this coefficient where the expectations on the left-hand side is positive. Okay, people are optimistic when the price is high, while the actual capital gains relate negatively to valuation. So people are pessimistic. The actual thing they should be is pessimistic when the valuation is high. So here I show you, now of course there are some econometric issues because the predictor variable is quite persistent. We do the Shambaugh small, correction and all that, and it's just so strong that this doesn't go away. Okay, so here are the coefficients that we estimate for nominal housing prices or real housing prices. You see they're all positive, okay? So people are optimistic when the price is high, while the actual capital gains turn out to be negatively related to the price-rent ratio, okay? And if you do a hypothesis test of the two being equal, even if you do the small sample bias correction coming from the persistent regressor, you're just going to outlandishly reject that these two coefficients are possibly equal.
So who brings about the correction? Who does the selling if people are optimistic?
Oh, we will get that. I can't tell you later because in the model we're going to have a representative agent. He's going to price the thing, but he's not going to sell anything in the aggregate. It's a very aggregate model in order to be able to get some analytics out of it. But obviously in the 2007 housing markets, we knew who started to sell. That's not going to be in here, okay? Okay, so then the third deviation from rational expectation had this dynamic component, and we're going to show you that in response to certain developments in housing markets, people initially underreact, and then with the delay, they overreact, okay? So first underreaction, delayed overshooting. So what we're going to do is we're going to have local projections of the form where we regress some variable h periods out on some measure of what happened in the housing market. And here is just a realized capital gain. Okay, this is econometrically well defined. It is not given a structural interpretation. It's just a data moment. Okay, so we're going to project future variables on the current capital gain or on the lag capital gain, and then we're going to look at these coefficients BH. Okay, so what we're going to use on the left-hand side? Well, first thing we're going to look at what are actually housing capital gains actually doing. Okay, what are capital gains actually doing? And the second thing is what is the forecast error that people do going forward following this positive news in the housing market. Okay. And I want to look first at this, the dynamic evolution of the 1 year ahead forecast error in response to this good news in the housing market. Okay, and this is the graph on the right. Okay, so you see here we have the various horizons H. How does this 4-quarter forecast error look as we evolve through time? Okay, and you see initially it is positive. Okay, which means initially in response to this observed capital gain, they underpredict the actual capital gains materializing in the market. And they do so for quite a while, okay? They do so for quite a while. Then things become, they get it about right. But then, after about 3 years, thing turns round and they become too optimistic, okay? So for a long time, they have been too cautious. But then after some time, they become too optimistic. So how can this happen? Okay, what's happening? So I've shown you on the left-hand side the cumulative capital gains that materialize in housing markets if we do the same projection but just using cumulative capital gains on the left-hand side. Okay, you see there's the initial gain, okay, the initial good news that has happened 1 quarter to the other, and then you see that there is this very persistent further increase in response to a past increase. It's very well known that the capital gains in housing markets are highly autocorrelated, okay? And that's what this shows. So following a capital gain, it's reasonable to assume further capital gains given the way housing prices behave. But then at some point, this is leveling off. When is this leveling off? Well, precisely at the point when people have caught up. So they have finally caught up with the capital gains. But then the capital gains stop from being there, okay? There are no further capital gains. But at that point, having seen this increase, they become too optimistic, okay? So they gradually catch up with the dynamics in the housing markets. By the time they've started to catch up, there cease to be any further gains in the housing market. At that point, They are too optimistic. And that actually explains how housing market valuation can negatively co-vary with expected capital gains. Okay? So positively co-vary with expected capital gains and negatively with the forecast errors. All right, so now we want to present a very simple bare bones model that is able to quantitatively replicate this. So it's really the simplest thing we can think of as a representative and risk-neutral household. We're going to relax all these assumptions in the full model. There's a representative and risk-free, risk-neutral household that is caring about consumption of a non-durable good, and that cares about the durable good here, the housing. Okay, and there is also going to be, there are houses that you can own, and there are houses you can rent, so that we can talk about the price-rent ratio. Okay? And then the only shock in the model is going to be a preference shock, okay? Which is the most loved shock of the rational expectations literature that gets housing pricing move. Okay? You fall in love with housing and then you dislove again. And that's how you get a boom and a bust. Okay? So we're going to have this shock. Okay? And then the only non-standard feature really in the model is going to be the subjective probability measure, the subjective prior that we endow the agent with. Okay? And actually, the subjective component is only going to relate to housing markets. All other variables, we keep rational assumptions. Okay, the budget constraint is very simple. You can consume. You can. These are the houses you purchase. These are the depreciated houses that you sell. This is the real value of houses. There's the rental price that you pay for rental units. And then there's some income, which is exogenous. And really, there's only two first-order conditions here. Okay, the one that determines the rental value is given by this preference parameter, and then there's the asset pricing equation that says your price today is going to be a function of the rental value of housing plus the expected depreciated future sale value of the house. Okay, standard. But here now, of course, this is going to have a subjective component on the right-hand side. Okay? Okay, so now that's going to be the model. That's it. That's the model. Now the only thing we need to do is talk about the beliefs. Okay, and now we're going to introduce some extrapolation. We're going to, introduce it our way, but it's not really relevant, how you really introduce it. You could have, if you love diagnostic expectations, if you like some other behavioral stories, it will work very similarly. Okay, but we have this sort of full Bayesian sort of approach to doing it. Okay.
Sure. Because it's about this Bayesian, because in general Bayesian you get observations of the world, right? Yes. You observe something and you update. But in the houses, for many people, you don't observe. You say, so you have your house, you are living on that, you observe that some of the people maybe doing gains, but you don't know because you haven't sold it, or maybe you haven't buy anything. So it makes sense that maybe you're not caught up with the with the average expectation.
So this is right. So one way why there may be some sluggishness is that you only infrequently update. That is one way why you would get extrapolation that is sluggish relative to what you should do. Okay, that would be an alternative way to get very weak extrapolation in the aggregate. Okay.
Because here you assume that you do trade every period.
Well, you don't trade because it's representative agent. Everybody's just so the only thing this model, this very simple model, is going to spit out now. It's going to be beliefs and housing prices, which is the only thing we've talked about so far. Okay, we are not going to talk about trading volumes. We're not going to talk about defaults and all that. Okay, it's just to see how far can we get with this belief story.
Even if 1% of the people trade, at day T, the price at which they want to trade is the left-hand side of this equation.
That's right. You could say, draw a random sample from this population. Would they trade? They go in the market. They would bring about this price. They would just keep it and would go back. Okay. Absolutely. So, okay. So here's our little story. It just says, it's as simple as it can get. It says, well, the capital gains. That's the prior now with which we endow these patients, okay? And the prior is going to be wrong. Obviously, it has to be wrong, because if we were right, we wouldn't be able to match the expectational deviations. So what's the prior they believe in? Well, they think there is capital gains have a persistent and a transitory component. That's it, okay? And for simplicity, we're just going to assume that the persistent component has a random walk. Okay, that's not too bad because we see that the 5-year hat for capital gain expectations behave very similar to the 1-year hat, and that's what this model would spit out. Okay, but we are not banked on this. You could have some mean reversion in there.
So is it important for getting momentum that people formulate their beliefs in that way? That is to say, there is an underlying process which determines an average capital gain, as opposed to instead having in my mind a process where the price-earnings ratio oscillates over an average.
Yeah, so we can have we can complicate this and say there's mean reversion in capital gains as a function of the deviation of the price-rent ratio from its average value. And if that mean reversion is sufficiently weak, actually we have extensions in our
suppose my model is QT equals zeta BT plus epsilon t. Would your conclusion
zeta BT or
yeah? I think instead of thinking of the world as having this capital gain, I think of the world as having this price-earnings ratio.
Oh, that is not going to work. The moment you think about the price level, you're not going to get momentum. That's very important. That is very important and well understood. Okay, so really need to think about the capital gains and about the expectation of capital gains.
But in many of those models, the rational expectations equilibrium is
of this
equals a constant times z.
Exactly.
So there is a core specification.
Absolutely.
In the way people think of asset prices.
Exactly. They don't have the anchor in terms of levels to the fundamental. And that, in essentially, what people do not know is this mapping from the fundamental to the market price. Okay, so they have no understanding of how exactly the market prices, and that probably in some asset market isn't all too bad an assumption. Okay. So, but be it as it may, so this specification, what is going to give us, and that's what we care about, well, we can now write the subjectively expected capital gain, BT, as a simple, Kalman filter equation, where the new capital gain expectation is the prior capital gain expectation, plus a Kalman gain that depends on the relative variances of these two shocks, okay? And then the news that comes to you, okay? The observed capital gain relative to what you expected, okay? And that's what we see. Here we see the extrapolation. You see a capital gain that is slightly above what you expected, well, you become slightly more optimistic, okay? And the point is going to be that, a little bit of response on this front here is going to do all the trick. Okay, and then we're going to impose an upper bound on beliefs. That's because we have the linear utility specification. That's to avoid that you get to infinity, to a situation with infinite utility. Okay, so that's it. But you could take this from other mechanisms, as I said before. Okay, so now, how plausible is that? So when we look at our survey data, we can construct measures of expectational surprises. So here is, for instance, the quarterly capital gain that we see in the data relative to what people expected. Okay, so this is the 4-quarter capital gain broken down to a quarterly rate. Okay, so this is a measure of news. Okay, you expected a certain capital gain. This is something that came out. Okay, and then we can look at the expectational revisions from one period to the next. Okay, and you really see this, this upward sloping relationship that, as the news gets more positive, the revision gets more positive. Okay? And there are actually only 4 large outliers of this relation, which all relate either to the Great Recession, 2008 Q3, 2009 Q2, or that relate to the pandemic. Okay? Okay, these are these two. So I think, this is fine. I think it's not an unreasonable specification of how updating works. Now, what does this now imply for the behavior of housing prices? Well, the equilibrium housing price, if you now put this expectation on the right-hand side of the asset pricing equation and solve the equation, okay, you're going to find out that the equilibrium price is going to be driven by the fundamental, okay, sure, because it's current rents. And then it's the discounted optimism, degree of capital gain optimism, okay? So the actual housing price is going to be driven by the degree of optimism and the fundamentals. Now, if you are more optimistic, then because this enters here in the numerator with a negative sign, you're going to have a higher housing price. Okay. So in here you see now how momentum arises. Okay. As you become more optimistic, you drive up the housing price and produce the capital gains that you seek to chase. Okay, and therefore generate further upward revisions in expectations. Now, the interesting thing that I want to highlight here is that in a world in which the natural rate of interest is lower, which in this environment would amount to a higher discount factor beta, okay? A higher discount factor beta, maybe due to lower growth rate, more idiosyncratic risk, or things like that, okay? That, or more, less time preference rate, all these factors going to increase beta, and they're going to make belief revisions more relevant for house price changes, okay? And through that, the model is going to predict that in a low interest rate environment, these expectational deviations become more relevant for pricing, okay? And that's what we're going to show. Now, but before going there, I'm going to show you the forecast error patterns that we can get out of this simple model once we put some parameters to it, okay? So we're going to, we have only a few parameters and we're going to tie our hands. We're going to take a depreciation rate of 3% per year. We're going to make the preference process persistent. This is the gain that we've used in our stock price paper. And then we're going to choose the discount factors to match the average natural rate of 0.75% over the sample where we have the surveys, okay? That's it. And then the only thing that we really use freely is the volatility of the preference shock, the innovations, and we're going to match them to get the right volatility of the price-rent ratio. Okay, so that we match by design. So how do we do in terms of matching now house price behavior? I just told you we're going to match the standard deviation of the price-rent ratio by design because we have put the preference shocks sufficiently large to get that. We're going to get a very persistent price-rent ratio, probably not so surprising given that we have persistent shocks, but we also have the belief dynamics, okay? We're going to get rather volatile capital gains, 2/3 of what we see in the data, and we're going to get very autocorrelated capital gains, okay, quarter on quarter, okay? So we're going to get a high thing. So is this difficult to get if you had rational expectations? Yes, it would be very difficult to get at the same time a highly autocorrelated level of the house price and very autocorrelated capital gains. Okay, there's a big tension between the two. Now, if I shut down the subjective belief component in this environment, what will happen? So let's take the same parameterization, shut down the subjective belief. Well, house price volatility will collapse to about 1/3. Okay, so in this setup, 2/3 of the volatility of housing prices would be driven by subjective beliefs. Now let's have a look at whether the subjective beliefs that come out of the model actually are plausible and have the same patterns of expectational deviations as in the data, okay? And that hopefully is going to convince you more that, a substantial share of house price fluctuations can be due to these subjective belief fluctuations. First thing, let's have a look at the sluggishness parameter. Remember, that was between 2 and around 2, maybe 3. And in the subjective belief model, if we run the Kopyanko-Ratnichenko regression in our model, we're going to get this 2. Okay, so there's insufficient fast updating unconditionally in response to news. We're going to also get that the expected capital gains of these agents in our model are pro-cyclical. Okay, they vary positively with the price-rent ratio in line with the data. The actual capital gains are going to be counter-cyclical, okay, but less so than they are in the data. In the data, there's more mean reversion than we have in our model, okay? And there are various reasons why this could be, because there are a number of things we don't have for the mean reversion, like defaults and banking panics, what have you, okay? Okay, so this is, I think, quite nice. Now, what about the initial underreaction and delayed overshooting? We also get a pattern that is broadly consistent with that. So following, if you remember, we run these local projections of the forecast errors on a lagged capital gain, okay? And following a lagged capital gain, initially people are too sluggish in updating, okay? But later on, they become too optimistic. So we get the broad patterns right. All these three things with a very tiny ingredient, just this little degree of extrapolation of capital gains. Okay?
The red line goes to zero eventually?
Yeah, it goes to zero. Okay, so, all right. So how much time have I left? Not a lot. Now, I want to get one thing. You can now I told you that the model is going to produce an increase in the standard deviation of the price-rent ratio in response to a fall in the natural rate. Okay? And the reason is that the feedback from expectational revisions gets stronger in the asset pricing equation. Okay? Now I want to run a sort of a quasi test under the standard assumption the natural rate is an exogenous object. So we could run just a local projection of measures of the standard of the volatility in the housing market on that natural rate. Okay. Now, of course, the standard deviation is difficult to measure because the housing price is a very persistent variable. So you need to have some window of observations. Okay. So what we're going to do is we're going to project a window of h quarters around the period t onto the natural rate in that period, which is the natural rate as estimated by Holston, Laubach, Williams. Okay. And then, under that interpretation, you could give a causal interpretation to B and want to see whether there is actually this positive relationship between the volatility of housing markets and the natural rate of interest. Okay, and in fact, we find something if you do the estimation bandwidth sufficiently wide. If you use only 4, 8, or 12 quarters around the period, you're going to get very noisy estimates of the standard deviation, and therefore you're not going to do well. But as you increase the bandwidth of the observation, you're going to find this positive relationship in the data, as predicted by the model, between the level of the natural rate and the volatility in housing markets. Okay?
Measure the natural rate?
Well, we take it, we don't measure it ourselves. That's the first thing. We take it from Laubach and Williams, their estimates for the United States. So we can also, sorry.
Even without extrapolation, no? Because if you magnify these shocks to the zeta, just because the beta is larger.
So there could be other things behind that, like it could be obvious. Yeah.
You had 1 over 1 minus beta times 1 minus delta times.
The asset pricing equation here. Yeah.
Yeah. So even if the term of the expectations is constant, just the change in beta.
Exactly. That's what we do. We just do the change. That's our story. As beta changes, then even for given fundamental volatility, you're going to get more house price volatility.
The deviation of the level of the house.
No, this is the log deviation, the percent deviation around the sample mean. So that's what it's the theory analog in the data. Okay, the percent deviation or the log deviation.
What you were saying is that you will get the same under rational expectation.
No, you will not get, because you need, in order to get, you get very little. Okay, in the limit, in order to replicate under rational expectations the persistent price-rent ratio, you need very persistent size, and that is the tension, and therefore you will not, in the limit with a random walk, you will get nothing. Okay. Okay. So I thought I convinced you already that there are expectational deviations, but no. Yeah. Right. No. There's going to be virtually no. If you have very persistent psi, which is I think is a reason to get the then you will not get it. We get nothing. We have an expression in the paper. Okay, so now you can also look at more simple measures, like take the pre and post changes in the natural rate in a number of countries, pre and post 1990 changes, and look at the pre and post 1990 changes in the percent deviation of house prices from their sample mean in the respective subsamples. And you're going to find that in all countries here, Japan, Canada, France, UK, USA, Germany, you're going to see this downward revision in the natural rate and the upward revision in the volatility of housing prices. Okay, so now I was asking how much time I've left.
10 minutes.
10 minutes? Okay. I'll maybe leave some time for questions. Okay, so
9 minutes.
9 minutes, okay. Okay, so now we put this whole machinery, okay, into a new Keynesian model, the textbook model augmented by a number of features, the subjective beliefs, obviously, but also a housing production sector. We have a now endogenous labor supply, obviously. We have an effective lower bound constraint on the nominal rates, and we're going to look at this falling natural rate of interest situation. So the full model is going to still replicate the forecast error patterns that we see in the data, and then we're going to study Ramsey optimal policy in this framework, and we're going to derive second-order approximations in closed form for the Ramsey problem. Okay, so the new insights that we really get from the model is that now you get an additional component. Now, lower average levels of the natural rate not only going to lead to increased housing price volatility, but they're going to trigger increased, this is going to generate demand effects, okay? Housing investment is going to respond positively to these house price fluctuations, okay? And of course, now monetary policy needs to, trade off. If you want to stabilize the output gap in the presence of these demand pressures, now you have to sort of respond with your interest rate instrument, okay? And if now these pressures become stronger because the natural rate is lower, you're going to have to respond more. So what we're going to get is more volatility in the natural rate of interest.
Perhaps you could tell us briefly what is the feedback effect in your full model from house prices to real activity?
Yes, I'm going to get at that if I have time. It is a simple instantaneous supply function that says with decreasing returns to scale. So you take inputs, transform them into housing output with decreasing returns to scale production function. And we have a reasonable supply elasticity in there. That
when house prices go up, there is a housing boom.
Exactly, there's a housing, is an investment boom. Exactly, there's going to be an investment boom. Okay, and so here is the modified monetary policy problem. We have the standard objectives that we have in the new Keynesian framework, inflation and output gap now slightly differently defined because we have the housing market in there. But there is also the house price gap. Why do you care about the house price gap, the deviation of house prices from its efficient value? Well, it's going to generate these allocational distortions, too much investment in housing, too little investment in housing, depending on the deviation, and that's something you care about. This actually...
So the expectations of the construction sector and investment is subjective also? Or
doesn't matter because it's within period.
Or in the period of construction?
Yeah, then you don't have to talk about that. Okay, firms and households have the same expectations. The policymaker is rational. Okay?
So basically, the last term captures misallocation of resources between housing
and non-housing consumption.
The term in pi square is also misallocation across continuum of...
Yes, exactly. That's a price dispersion. Yes, exactly. And that's the usual real activity dispersion. And then we're going to get actually this term is also going to show up in the Phillips curve, and that's interesting. If house prices are driven up, say by optimism in the housing sector, this is going to have dampening effects on inflation. So you can get a non-inflationary housing boom. And vice versa, once house prices fall below their efficient level, they're going to become inflationary. So what is happening? For a given output gap, okay, having higher housing prices means that more resources go to housing, less to non-housing consumption. That is driving out the labor-supply relation. Okay, labor supply expands as a result because that is the opportunity cost between consumption and leisure. Okay. So you have less non-housing consumption than you could otherwise have, okay? So for a given output gap, of course the output gap is endogenous to the boom, okay? You're gonna have that. And that allows the model to get a non-inflationary housing boom. And here you see the forward iterated Euler equation. And in this Euler equation is now this new term, that has the gap between housing prices and their efficient level. And in particular, we can show that the natural rate now in this in this setting with subjective belief is going to be the rational expectation natural rate plus this additional term that's going to increase in volatility, okay, as the natural rate falls. Okay, house prices become more volatile. These gaps will become more volatile, and therefore, as the natural rate falls, volatility of the natural rate increases. So last slide before I have no time for all this. Let's okay. Now let's look at what this implies for the optimal design of monetary policy. Okay. So in a world with rational expectations, where we shut all these subjective belief components off, okay, we are fully back to this. It's isomorphic to the standard textbook New Keynesian model. There's going to be no house price gaps. There's going to be no disinflationary components in the Phillips curve. The natural rate is the usual one, okay? And then, you know, with this parameterization in the old world, when I wrote my paper with Roberto Billi at the time, we were somewhere here in a, 3% real interest rate. We thought is a reasonable assumption, maybe 3.3. We were very disappointed that the lower bound didn't give us anything in terms of average inflation. Okay, it was a big disappointment. Now we can just redo this as we let the natural rate fall almost all the way to 0. You know, it's just still there. They're going to get a few basis points of average inflation. There's just no relationship under Ramsey optimal policy between the natural rate and the optimal average rate of inflation. Okay? Now, what happens now if we have these subjective beliefs? Well, first of all, even when the natural rate is high and the model is calibrated so that the volatility of the natural rate in both models is the same, you already get an additional kick. And the reason is that subjective belief dynamics induce relatively persistent variations in the natural rate, and that is a bigger problem for monetary policy. So you get already a somewhat higher inflation target. But now, as the average level of the natural rate falls, the volatility of the natural rate increases, and therefore you get a steeper reaction of the optimal inflation target to the falling natural rate. Okay? Now, of course, we can do the same thing in the rational expectations model. We just put exogenously more volatile natural rates in there. Okay? That's something we can do. In fact, the same volatility as in the upper blue line, what would we get then? Well, then we're going to move up in the rational expectations model too, and eventually we're going to catch up with the subjective belief component. Okay, so I have no time to talk about the macro tools. Just one slide summary. You need very volatile taxes. Okay, macro tax. You need not only, you need subsidies and taxes. Okay, in order to undo the things in the housing market, and they need to be very volatile. I think implausibly volatile given the tools that are available. So I think, in the end, monetary policy will have to do something, even in the presence of macro proof.
It could be like a regulation in the mortgage market.
Yeah.
And then do it, so you change the constraints and not the monetary authority to do it, right?
Yes, that's right. But I just think that the size of things that are actually done are in no proportion to what the model suggests would have to be done in order to eliminate the effects of the subjective belief components. Okay, in principle, you could design the optimal constraints, taxes or regulations on lending and borrowing in a way to achieve that, but they would have to have a lot of volatility. Okay, so that's it. Okay, so the message here is that the monetary policy implications of falling natural rates depend critically on the nature of house price expectations. Okay, if you are, if you want to take the observed forecast error patterns in house price surveys serious, then you're going to conclude that as we approach the lower and lower natural rates of interest, the volatility of housing markets is going to increase, the volatility of the natural rate is going to increase, and the lower bound is going to become a more binding constraint, and that justifies some, not a huge, but some increase in the optimal inflation targets. Of course, you could also, teach households that they shouldn't look at this way at housing prices. That would be great. It would be first best. Okay, you would get to much better outcomes. Or you could, of course, try and reverse the unfavorable trends in the background that give rise to the lowering of the natural rate. And that would also be a great policy. Absent that, I think it's on monetary policy to do what is needed. Okay. I think I'm still in time, 2 minutes.
Quite fine question. So here, firms that produce final output and the price setting, they are rational?
No, they have the same beliefs as the households.
Also the price setting?
Yes.
Price,
yes. Yes.
So in the full model, people are fully rational when they form
inflation expectations?
Yes, yes. Yeah, that is a thing you can obviously discuss. But we didn't want to make yet another deviation. I mean, Oliver has worked on what happens when inflation expectations deviate.
And you have zeta shocks?
They know the zeta shocks.
But the zeta shocks generate negative co-movements between housing investment and non-housing consumption. Is that correct?
Well, conditional on an output gap, yeah, but the output gap itself is, of course, an endogenous variable. Okay? So it's true, conditional on the output gap, there is this negative correlation. But if I can show you this is a good question. We're going to get, following a demand disturbance, like a monetary policy shock, we're going to get positive co-movement. That's important, right? And I didn't get to show you the impulse responses to a monetary policy shock. Let's see where they are. I think they're somewhere. I skipped over them. Here. This is this is not easy to get in these models. So you have a nominal interest rate increase, a persistent one, and then you see the output gap fall, inflation fall. That's all standard. Now look at the subcomponents. Both housing consumption falls as well as housing investment. Okay, and look at it. Housing investment reacts about 5 times as strongly than non-housing investment. That's what you want.
That's what you want.
Yeah.
Zeta shocks, as most shocks, other than they will not generate positive co-movements among all GDP components.
That we haven't really looked at. I think it depends also on the policy specification. I have the response to positive zeta shock in the learning. Yeah. So there is this thing here. You see under optimal policy, we don't have the decomposition into housing and non-housing investment here, so I can't tell you. Okay. All right, thank you.
Well, thank you very much.